Hello and welcome to this session in which we will discuss imposed non-exchange revenues, and that doesn't sound good at all. Imposed. Well, we are dealing with non-exchange transaction for government entities. Well, what do we use for governmental entities for non-exchange transaction? We use the modified accrual for revenue recognition. It means when the transaction is measurable and available, we recognize the revenue. Remember, measurable, it means we can quantify it, and available means we can spend the funds this current year, or the funds is available 60 days after year end. So very important that you understand how revenue recognition for the modified accrual generally works, and we did cover this in the prior session. But today we'll focus specifically on this imposed non-exchange revenue. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
As I said, imposed doesn't sound good at all. It's like imposed, like you have no option, right? Imposed are a type of government revenue recognized when the government imposes taxes or fees on individuals or entities, and entities, notice here, without a direct exchange of goods or services in return. So I am asking you to pay the taxes, but there's no exchange in return. It's a non-exchange. It's not like you pay for this tax, you get something special. You don't. You have to pay this tax. Well, for example, paying property taxes on your property or fines that does not entitle you to a specific service. So if you pay taxes on your property, you are required to do so because the government imposes this. Well, you cannot ask the government for a specific service because you're paying for property taxes. Same thing if you pay for a fine. It's a one-way transaction. This is what we mean by imposed, and it's non-exchange. Because if it was an exchange, you would receive something in return of equal value. Now, having said so, of course, you would receive services from government, but the point is you are not receiving any particular or specific service. Now, obviously, for example, property taxes, if we are dealing with this example, what do property taxes pay for? In most localities, property taxes pay for the school district. So if you have kids, you send your kids to the school and it's paid for. How about if you don't have kids? Well, you're paying property taxes and you're not getting anything in return. So the point I'm trying to make is these revenues for the government are mandatory by the taxpayer and they're non-voluntary. You cannot say, well, I don't have to pay taxes because I don't have kids that goes to school. And I know an individual that owns 3 homes and he does not have any kids, but he still pay taxes, local taxes, property taxes. So examples are property taxes, and this is usually the largest income for most localities, fines and penalties, special assessment, forfeitures. And we'll discuss those in details, starting with property taxes. We'll spend the most time on that. Property taxes are often referred to as ad valorem taxes. What does that mean? It means it's based on the value of your home. So if you own a real estate property like a home or a land or a piece of land, the government determines a tax rate based on the value of your property. So you might be saying, would the government value my property every year? Not necessary. That's time consuming for them. But usually it's based on the value. Since the last time it was valued, let's put it this way. For many localities, property taxes form the largest slice of the revenue. And I'm going to show you real quick. This is a simplified version of how property taxes are determined. So what happens is this. The first thing, the government will have a tax assessor. A tax assessor will determine the taxable value of the properties. Now, when I say taxable value, it could be the fair market value. It could be that they take other factors. Somehow, the government says this is the taxable value of your property. Again, it could be fair market value. The government could have their own underwriting or their own rules. In theory, as I said, this value reflects the fair market value in theory based on your taxes. However, as I mentioned, frequent reassessment is not practical. So think about a big city. They cannot send a person to reevaluate the property every year. So the government often adjusts the tax rate instead of reevaluating property value. So rather than going back and revaluing the property, what they do is they just adjust the tax rate when they need the money. And I'm going to show you what does that mean in a moment. So setting revenue goals. Remember how government works. It's funny, but that's how it works. First, the government determine how much money they need to operate for the year. They would say, okay, our budget is $1 million. For example, if a county or a city decides that they want to spend $1 million, that's it. They determine the revenue first. It's a great way to do business because they can always get the money. But they only expect $300,000 from sources other than property taxes, like sales taxes and other taxes. So they need $1 million, but they know they can get $300,000 from places other than property taxes. It means they are short $700,000. There's a gap. Well, what they would do next, the government divides the amount needed by the total taxable property value in its jurisdiction. So they would look at their property and they would say, well, if we need 700,000 and we have 50 million worth of property in this district, in this county, they will take 700,000 divided by 50 million. They will need to impose 1.4% tax rate on the property. So the property tax bills are sent based on the assessed value on each property multiplied by the tax rate of 1.4. Therefore, if you own a property in that county for 200,000, well, you have to pay 1.4%. and your tax bill will be 2,800. So this is how it works. Now keep in mind, this varies from locality to locality, from municipality to municipality, from county to county, from state to state. But generally speaking, this is how it works. Now, in certain states, property taxes are much higher than other states. I'll give you an example. I live in Pennsylvania and I also lived in New Jersey. Property taxes in New Jersey are very high. And the reason is because they don't have local income tax. So the state of New Jersey don't collect local income tax. In Pennsylvania, we have local income tax. They don't have it in New Jersey. Therefore, in New Jersey, they have to rely on property taxes. Because some of the income comes from local income tax, generally speaking, PA property taxes are lower. And that's why some people move from New Jersey to PA. Let's take a look at the accounting treatment for property taxes. Revenue recognition. When do we recognize revenue? This is important. Well, when it's measurable and available. Simply put, the tax has to be measurable. It means we can quantify it, put a dollar amount on it. Of course, you cannot record something with no figures, with no quantity. That's one. Two, it should be available to finance expenditure in the current year or collected 60 days after year end. So this is how property taxes work. Now, when the county or when the city issue a tax bill, once they issue that tax bill, the government record an account receivable and they can record a revenue. Why? Guess what? That tax bill is an enforceable claim to collect money. Why? You have no option. The government don't have to provide you any service in return for them to recognize the revenue. Once they issue that bill, that's it. They did their job. They can recognize the revenue. Why? Because you have to pay your taxes. Well, guess what? I don't want to pay my taxes. I want to sell my home. Well, someone else will have to pay the taxes. Well, guess what? I don't want to pay the taxes and I don't want to sell my home. That's fine. We'll take your home and satisfy the tax bill. So the government will get their money. They are entitled to it. They don't have to do anything in return. Therefore, as soon as they issue the tax bill, as far as they're concerned, they, in quote, satisfy their obligation. So if payment comes and later than 60 days after year end, the revenue must be deferred. If that's the case, if the revenue comes later, it must be deferred. Deferred means deferred inflow of resources. Now, would some people don't pay their bill? Absolutely. Not all property taxes are collectible. Some property owners may fail to pay their bill. I would not recommend that, but it could happen. They could have a dispute with the government. It's like, the government is not providing them, it's not fixing the sidewalk that they believe the government is responsible for. Or whatever the reason is, there's a dispute. Okay, that's fine, solve it in the court. Or they're in financial distress. They don't have the money to pay for it. Or for some reason or another, they are exempt like churches and not-for-profit. So government accounts for this by estimating the amount that will be uncollectible as remove it. Just debit allowance, credit receivable, but at least, we're going to give it some time to collect the money. Let's take a look at this multiple choice question from farhatlectures.com. Best city levied property taxes of $600,000 of the current year. Great. An estimated 25 will be uncollectible. Which of the following is the correct general fund journal entry to record property taxes levied? So which one is the proper journal entry? Well, is it property taxes receivable current 600,000? Yes, that's part of it, right? We debit that. Property tax revenue 600,000? No. Why not? Because we have uncollectible of 25, therefore A is out. Property tax receivable current 575. Bad debt expense? No. And property revenue 600,000? No, the property revenue is not 600,000. We're not going to get 600,000. B is out because the property tax revenue is not 600,000. Property tax receivable current 600,000? Yes. Property tax revenue 575? So far I like it. Allowance for uncollectible 25? Yes. So we debit the property tax receivable 600,000, credit revenue 575, and credit allowance 25. D, property tax receivable 600, bad debt expense 25, property tax revenue not 600,000 because property tax revenue cannot be 600,000. So the answer is C as in Charlie. What should you do now? Whether you are an accounting student studying for a professional certification, visit Farhat Lectures for additional resources, lectures, multiple choice that will help you invest in yourself.